Canadian TFSA holders with U.S. tech exposure may want to reassess concentration as NVIDIA eyes China-specific AI chip shipments by year-end. This is Modern Investing Techniques, episode 144. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. The S&P 500 sits at 7,676, down 0.4%. The NASDAQ composite is at 26,125, down 0.8%. The TSX composite closed at 36,305, down 0.3%. Fed official daily flagged the possibility of cold turkey rate moves, and the September FOMC window for new data looks tight. Treasury Secretary Bessent sees a good chance the fiscal deficit has already peaked. Remember, we covered AMD about 15 days ago on post-earnings positioning in AI names, and it closed up 0.99%. The lesson there was that even strong AI themes still need volume confirmation before adding size. Our simulated portfolio shows a cumulative profit of $314.12 across 51 trades. The win rate stands at 55%, and matched window alpha versus the NASDAQ sits at negative 1.7% across the rules-based trades since August 18, 2026. Canadian investors face a structural challenge when U.S. indices concentrate risk in a handful of mega-cap names, while the TSX spreads exposure more broadly but with less upside capture from those same growth leaders. Rosenberg highlights how pairing a core TSX sleeve with selective U.S. or international exposure can offset single stock concentration. The approach calls for a 60% allocation to a broad TSX ETF, such as XIU, and 40% to a U.S. small cap or international ETF, such as VIOO or VXUS. Quarterly rebalancing keeps any sleeve from drifting more than 5 percentage points from target. Historical results from the 2022 rate hike cycle showed roughly 15% smaller drawdowns compared with pure S&P 500 exposure. The same mix also picked up incremental Canadian dividend yield that the S&P 500 tends to underweight. Correlation spikes during global shocks remain the main risk that can shrink the intended buffer. U.S. investors gain the opposite benefit by adding international or small cap sleeves to dilute mega cap dominance. Low-cost ETFs make the rebalancing practical inside a TFSA without triggering frequent trading concerns. Now we move to today's simulated trade. This is a simulated trade for educational purposes only with no real money involved. Today's pick is TLG, Troilus mining on the TSX. The catalyst is drill results showing 8.84 grams per ton gold equivalent over 4.8 meters, 400 meters beyond the current pit shell. Price action shows a breakout above recent consolidation on the daily chart. We will monitor the 50-day moving average as potential support and watch volume against the 20-day average for confirmation. The stop sits 8% below entry to account for typical junior miner volatility. The target is plus 4 to plus 8% over the 5-session window if the mineralization trend holds. Confidence is medium because the intercept is confirmed, but broader precious metals sector rotation remains uncertain. This setup teaches us to measure extension distance and grade continuity against the existing resource model, rather than reacting only to headline intercepts. The fixed 5-session exit prevents holding exploration names through long gaps between drill batches. Invalidation occurs if subsequent holes fail to intersect comparable grades or widths inside the extension zone. No newly closed trades since the last review, so current holdings remain open and pending their scheduled evaluation. Centerra Gold filed an acquisition of 4,038,647 Azimut shares at 60 Canadian cents. That filing triggers early warning disclosure rules and can signal institutional interest before broader market reaction. Canadian investors can set free SEDAR Plus alerts for early warning reports in the precious metals sector to catch potential follow-through buying within minutes of filing. Morocco Strategic Minerals released underground and surface channel samples at Unain that returned high-grade copper values across multiple targets. Investors can normalize those grades to common thickness and compare them against district peer averages to rank projects before drill permits arrive. Both tools help filter promotional intercepts by focusing on width, grade continuity, and capital commitment size. NVIDIA is preparing small batch shipments of a China-specific LPU variant by year-end, with several customers already ordering. This creates a potential revenue bridge for holders concerned about export restrictions. Waymo completed 1.4 million rides monthly in California, moving the service from pilot to repeatable commercial scale. That volume supports continued investment in GOOGL's mobility segment, yet still sits below 5% of total revenue. Walmart posted its slowest U.S. sales growth in 6 years, pointing to consumer spending pressure that could compress discretionary categories further. Portfolio performance under the rules-based record that began August 18, 2026, shows 51 total trades with a 55% win rate. Cumulative profit stands at $314.12. Average return per trade is 0.62%, and matched window alpha versus the NASDAQ is negative 1.7%. The record uses fixed 5-session holds with entry at the next open and exit only at stop or horizon, $1,000 per trade, and full transparency on every loser. Too few trades exist yet to claim an edge, so the numbers function as a scoreboard rather than evidence of skill. Now here is something most retail investors get wrong when they first open a chart. Imagine you bought a junior miner last week after positive drill results pushed it above its 50-day moving average. Your order filled at the open, but the real mechanics involve checking whether price respected that average as support on the daily chart and whether RSI 14 stayed below 70 to avoid chasing an overbought move. Volume above the 20-day average on the breakout day adds confirmation that institutions are participating. MACDE crossovers can flag momentum shifts earlier than simple price action. Professionals always compare the current setup against the 200-day average to distinguish short-term noise from longer-term trends. What most retail investors do not realize is that technical tools excel at timing entries and exits within an existing trend, but fail when used to predict major reversals without fundamental catalysts. The concrete misconception to avoid is treating every moving average bounce as a high probability trade. Instead, require at least one confirming indicator such as rising volume or RSI divergence before committing capital. Before we wrap, watch how volume develops on TLG over the next few sessions and whether the 50-day average holds as support. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. This show comes to you from the NARA Network. If you want another sharp daily briefing, Unintended Consequences has you covered. True stories of good intentions that backfired. All our shows are free at naranetwork.com. The Do Positive Pod is the club for people who do something about it. Episodes and the dispatch wall at naranetwork.com, the DP Pod. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't last?